G'day, I'm Jonathan Bayes. It's Monday the 29th of July and some portfolio thoughts from us this week. A week to go before Australian corporate reporting season starts in earnest. Rio Tinto kicks it off on Thursday, our time this week. But next week, Commonwealth Bank, AMP, Transurban all report, and then we're pretty nuts for the coming couple of weeks. Last week was a busy week in the United States, particularly on the technology front. On the earnings side, again, the tech companies doing well, general industrials not so much. Google was an absolute standout last week. Facebook was pretty good as well. And to round out the tech heavyweights, we've got Apple numbers on Wednesday this week, which will be interesting actually, probably not likely to be a positive surprise. Operating momentum in that business a little bit softer than it is with the other big platform companies. It's a huge week for markets, both on the data front, but also two trade talks recommence this week between the trade representatives of the United States and China. So I'm sure we'll see some headlines through the week. But also too, we have payroll data in the United States and also manufacturing sector activity data on Friday night as well, which markets will certainly be focusing on just to sort of see whether or not the US economy has been affected any worse than last month from the slowdown in the global economy. It was really interesting. German manufacturing data for last month at an early glance was really continuing to be really horrible. So at some point, short of a trade deal, it feels like it will impact the US economy, but again, markets not showing any signs of softness. In Australia, markets up around 10-year highs again. We're up 23%, including dividends year to date, which is an incredible performance. But just want to remind investors and clients that, again, what you pay for an asset has a really big determining factor on what you're going to make as a return. And so, CommBank on 16, 17 times, Woolworths on 24, 25 times, Medibank on 24, 25 times. All for companies with questionable earnings outlooks. I really sense a loss of momentum will start to emerge in the coming couple of months. And some of the value names that we've been holding on to and indeed adding to, I think are likely to start performing a bit better. And really interestingly, in July, we've started to see a lot of these stocks do better. So IWF last month was the best, IWF last week was the best performing stock, up 12%, on some solid funds under administration figures. I say solid, they weren't outstanding, but again, the market is pricing this stock that the funds are running out the door, and they simply aren't. And I think a lot of investors are forgetting, the underlying franchise value that IWF potentially has in, an industry that I think, offers some really great growth attributes going forward. Nufarm had a really good bounce too, with a lot of short covering. There was some positive press out on Challenger, and on the whole, the portfolio started to show a little bit of life. And some of the momentum sectors starting to roll back a little bit. And, Rio Tinto had numbers on Thursday, but the miners particularly started to soften up a little bit last week on concerns of rising Chinese steel inventories. So, we'll watch this space. In other news, we've actually had an interesting impact of falling interest rates here in Australia with La Trobe. One of our favoured funds cutting the credit rate to the 12 months term account from 5.2% to 5.05%. I don't think that's necessarily a bad thing. We've had rates cut by 50 basis points, so a 15 basis point haircut feels entirely sensible. But it's important to flag that up. Wouldn't be surprised to see further cuts to rates from fixed interest funds in the coming couple of months. Anyway, it really kicks off in the week or two to come on the earnings side. And any questions, give your advisor a call. Thanks.